going to close and you're going to get into that house and have no worries throughout that entire process. So Scarlett, I know you want to talk about a couple things today as far as how we're going to talk about some different loan programs that'll benefit first-time home buyers that are trying to save some money for whatever it may be and take advantage of some of the great programs out there that get qualified people into homes, whether you're a regular person or a veteran, a firefighter, police officer, whoever it may be. I mean, we all deserve to get what we want. So where would you like me to begin?
Well, I just had to leave here because you know me, Josh. I love the culture of your company with Movement Mortgage. So I'm kind of letting them slide through and look at some of the stuff. And then, this is my favorite one. But did you want to talk to them about your process first? Because are you able to see what I have up on the board? Because it's one of the things I like most about your company.
I can, yeah. So I can definitely touch base on that. So with standard mortgage companies, guys, it's right now you're between a 45 to 60 day close. So one of the biggest misconceptions that people think is, okay, I need to get a mortgage and let me go to my bank. So right now it's 9 o'clock at night and Scarlett and I are on here working when we could be at home with our families or at a bar somewhere. I mean, it's been a rough week. But we're on here. I mean, we take this very seriously and we care for you guys. And it takes that kind of dedication and customer service to get you through a transaction nowadays. Because when Scarlett was doing loans back in the early 2000s, there was half the paperwork needed and half the dotted lines to be signed on.
And they had to sign them in person, by the way.
We need to source a $100 deposit into your bank account that you may think is completely crazy, but it needs to be done. So with the slide that we're on now, this is just a little bit, and I want to touch lightly on my company because this whole presentation is about you guys and what Scarlett can offer you and how we can help you get there. So with my company, it's based on a 671. So standard, when we submit your loan, we have all your documentation. That file is underwritten within 6 hours, which means you have a full loan commitment. The average lender, it takes them about, I don't know, Scarlett, what would you say, 72 hours to get a file back underwritten, maybe even longer.
Yes.
And our business is built on a 7-day clear to close. So I've closed loans in 8 days. That definitely is not the norm. But if it has to happen, you guys are in a time crunch or there's a property that you want and you're under the gun to get it, we can make that happen for you. But the biggest thing to understand in this business, as much as we work for you, you guys need to work for us. So when you go under contract on a home and you need to deposit your earnest money, which is basically good faith that you're purchasing that home, that needs to be done in a timely fashion. Mortgage documents need to be sent over to us within 48 hours. Because that way it allows us to do a smooth closing and you're not scrambling at the last minute the day before closing to get some bank statements over and everyone's stressed and Scarlett's yelling at me and I'm sad. So we want to avoid that. But were there any questions on the process or anything in particular with mortgages and how it works and getting approved?
Well, I would like to say if anybody wants to type anything, questions about this, but that's basically how your company ended up winning my business was, if I remember, one of our board members, before he was a board member, Jerome Macias, you closed him in 2 weeks and he was VA. Now that was a different time because it wasn't as crazy as it is right now. And I would never recommend, ever recommend us going to contract and saying we're going to close in 2 weeks, but working with a company like Movement, I have found that our offers are stronger, Josh, because we can close in 30 days. With most bond loans, I believe, I'm told it's like a 45-day close, and I think you guys can do it in 30 days, correct?
Correct. I mean, we've got one right now that we did in 2 weeks. Again, I mean, it depends on the time of the month. There's a lot of variables. And it depends on the clients. I mean, I've got a client right now that literally the agents on the other transaction are like, how are you leaving this transaction to the last minute? Why are we doing a same-day closing? The client took over 3 weeks to get his 1099s. We couldn't order a transcript waiver for his 1099s, and I'm going to lose you here because this is mortgage talk. But the moral of the story is he waited to the last minute, repeatedly asked him, the realtors asked him, he wouldn't send it, and then we scrambled to get a closing done that barely closed on the same day. Those are things we want to avoid. So doing what Scarlett's talking about, being accountable, getting everything done, yeah, we're able to do them. Where we can get them done in 2-3 weeks, but the standard norm is about 30 days for us when other lenders are 45, even maybe a little bit longer for the down payment assistance loan.
Exactly. Okay, so we're going to jump right into, I'd like you to explain, and actually this is going to be a good education for me because I know I'm the one that's always throwing bond. Explain to us your program and then explain to us the half a bond or whatever they call it.
Okay, absolutely. So our company came out with its own proprietary down payment assistance loan. So the reason they did that is, for one, the $15,000 that I'm sure all of you have heard of, either through Scarlett or from friends that have used it. It's a great program, but that money will be gone by October. So that money was from the TARP fund, which is old bailout money back from 2008. That was never used. So currently right now there's about $5 million a week of that money being used for people that are buying homes. So it's, key if you want to get a home, we move quicker on it than later, but that's why we came out with this program. And what this program does is it's a 3% down conventional loan. And if you meet the income requirements, we will pay your full 3% down, and all you have to come up with is the closing costs. And then in some situations, in slower markets, the seller can pay some of your closing costs, which we can touch on later. But more importantly, the biggest difference between the two is the interest rate is a little bit better than the down payment assistance loan through the state. But you do have to come up with the closing costs. Now, the other caveat is you need to make under a certain amount of income. So when qualifying for that loan, it goes by what is called an AMI for the area that you're buying. So that's an average median income. So, for instance, you make $60,000 a year and the average median income is $58,000, you wouldn't be able to get that loan. So therefore, we would look at the other down payment assistance loan with the $15,000, which gives $15,000 for your down payment and closing costs. And, on top of that, the income limit is a little bit higher. So on a conventional down payment assistance loan, you have to make or under $82,000 per year. So those are really the main differences between the two. Great programs. One is meant for someone and the other one's meant for someone else, depending on your situation.
Okay, I have a question. Sorry, and I know that other people will. Yeah, guys, there's a chat box down in here, and if you have any questions, now is a great time because if any kind of questions on how that works. But, okay, so I just noticed you can give, first, normally if it's an FHA bond, you can only get 3% concession. I just saw that you can do up to 4% with your down payment assistance. Is that correct?
Say that again. Yeah, seller concessions, you can get up to 4%, correct?
Well, that's pretty good. Because I know that we just had one with a client that you and I are both working with, and I think they were looking at going FHA, and they could only get, is it FH? No, it's conventional. They could only get 3% contribution, and with mine, it kind of kicked them out. But that's a whole nother, we'll talk about that client later. But is that correct? So in this situation, my contribution that I make plus their 3% would have made that work, correct?
That is correct, yep.
Okay. What is the difference between the down payment, the bond with a conventional, and the down payment bond with FHA? Because I hear all the time, and I know that's what everybody's asking you that, so I'm just going to ask it for them. What's the difference?
Okay, so the main difference between the two, one is the down payment, and two is the mortgage insurance that is associated with the loan. So the down payment is only 3.5% opposed to the conventional 5% down. And then on the conventional down payment assistance loan, the mortgage insurance that is associated with it, and for anybody that doesn't understand what mortgage insurance is, on a conventional loan, unless you put 20% down, you have mortgage insurance. It's basically an insurance policy that the lender takes out on you in case you stop paying the loan. On the FHA loan, you have mortgage insurance for the life of the loan, no matter how much you put down. So on the conventional bond, even if you put 5% down, the mortgage insurance is cheaper. The factor is cheaper than what it would be on FHA. 9 times out of 10, I'm going to recommend a conventional bond because the payment ends up being much cheaper short-term and long-term than FHA. There are some instances, if your credit is, towards that lower score, you need at least a 640 to qualify. Sometimes we have no choice but to go FHA because it will not take as a conventional loan. So we would do an FHA loan. I mean, in the scheme of things, it's maybe a $30, $40 difference, if that, per month. But if you plan on holding on to that home for a little while, that may mean more to some of you than others. $40 over, 6 years, it can add up. I mean, it really depends on how you look at things.
And
both great programs. Again, it's for each individual need.
Okay, I've got a question on that. So like with I already know the answer, so it's a stupid question, but, it's not. With the FHA, you always have that mortgage insurance. With conventional, that's why one reason you like to, because you can get rid of it, especially.
Correct.
Now, is your program a conventional or is it a FHA? You may have said that and I just didn't catch it.
It is conventional.
Awesome. How long, we have a question in here. How long will the mortgage insurance last in the conventional loan?
How long will the mortgage insurance last?
Yes.
Okay, so say you put 5% down. It really depends on a regular, let me say this first. There's a couple different ways you can get rid of that mortgage insurance. So that question is double-sided. If you're just put 5% down and you're making one payment every month, it could take, 3.5, 4 years to get rid of it, right? Maybe less, maybe 3 years to get rid of it. So there's a couple different ways you can get rid of that mortgage insurance on conventional. So say Scarlett finds you an awesome home and you got tons of equity in it because she's a rock star, and finds you the best home available. You're super happy. You've already got, you put 5% down. You bought the home for $200, but it's worth $210. So you've already got equity in the home more than the 5% you put down. So say after a year, the market rises up. Your house is worth a lot more. You make an extra payment here or there. You can reach back out to me and say, Josh, hey, we had Scarlett run a CMA. It looks like our house, and the CMA is basically an automated valuation. A realtor gets a CMA and she compiles comparables that have sold in the area to justify a value for a home. And you can reach out to me and say, hey, we had a CMA done. It looks like we've got 20% equity in our home. What we would do then is order an appraisal. And if there's 20% in the home, the mortgage insurance would drop off right then and there. So instead of waiting that 3 years and paying it down, you can get it off that way as well, which makes your payment cheaper and frees up capital for you. So there's 2 ways that you can really get that mortgage insurance off. So to answer your question, on a standard, making your regular payments, you'd probably be looking at about 3 years to get that off.
And that's one reason we both like conventional, right, Josh? Because FHA, it never goes away. Correct?
Correct. It's there for the life of the loan. Some people don't mind it. They're happy with the payment, with it in there. But yeah, that's what I was anticipating. I really don't mind. Some people don't have a choice. On a standard conventional loan, a 640 credit score is going to get you a horrendous rate. So on a conventional loan, a 740 credit score is seen as, the bee's knees, the best score you can have when it comes to getting a conventional loan. There's no adjustments to your rate. An adjustment basically is, the lower your score, the higher your rate is. On an FHA loan, a 680 is seen as the top dog for that loan. So if you have a 680 credit score, you're going to get a better rate on FHA than you would have on a 680 on a conventional. So some people prefer that. A lot of first-time home buyers like FHA loans over conventional. But if it's a home you're going to hold for a while, I mean, Scarlett will agree with me, it's best to do a conventional loan.
Yeah. Yeah. So this down payment assistance, the $15,000 should be gone by October. How long is your program going to be around for, do you believe?
It is around forever.
So basically, as long as somebody at this point, if you can find, I mean, and that's the hard part in my market, is finding that 3%, because, you know, unfortunately it's a seller's market, and sellers are going to be looking at you saying, hey, I can't give you 3%, but, you know, we can always try. A secondary thing is, even if we don't get it in the beginning, a lot of times, like I'm doing right now with our client we're working with, you know, the inspector who was part of our team, you know, not part of our team, but, you know, that's to me the first time we go and ask for more on our contract. You know, that's when we can find problems and ask them to pay some of the concessions and closing costs and kind of help us with that. But how does it work for income on the down payment assistant? Isn't there an income cap as well? Like, what is the difference?
Yeah, so the limit on the down payment assistance loan to the state, and I touched on that earlier, is $82,000 for a conventional loan. On the down payment assistance loan that we offer, it's a little different. I'd say it goes by the AMI, which is the average median income. So that's obviously going to be a lot lower. So if you're over that amount, I mean, there's still an option for you. You can do the down payment assistance loan. But for those of you that have money saved up, I always recommend the standard conventional loan, like what we call a home-ready loan. Interest rates are great, only 3% down, and the mortgage insurance is cheaper. Because if you don't need the $15,000, I tend to tell the client, I mean, you guys be the judge of this, and you can comment in the box. I mean, you tell me what you would like. If you're in a situation where you've got, say, $20,000 saved up in your bank account, and we can offer 3% down, and say the seller's going to cover a portion of your closing costs, and you're coming out of pocket $10,000, and that's it. Would you rather come out of your pocket $10,000 and have an interest rate of about 4%, or would you rather have all your closing costs paid for, be bound to that house for 5 years, which I'll touch on next, and have an interest rate of 4.875? I mean, honestly, I would use my own money and get a lower rate, have a better payment over the long term, and recoup my money later. And what I touched on for 5 years, with the down payment assistance loan, you have to stay in that house for 5 years. Otherwise, you have to pay a portion of that $15,000 back. So each year, it decreases by 20%. So say you live in the house for 3 years, and then you decide to sell it or rent it out. You would pay back 40% of that $15,000 to get out of that house, which would be $6,000. And by that time, you would have equity in the home, so it wouldn't really be too much of a big deal. But, I mean, it's just something to think about. I mean, it's always nice to use somebody else's money, but, you know, there may be some of you listening in that rather have a lower monthly payment and not worry about your cash in your bank. And then some of you may say, well, you know what, for the hell of that, I want to save all the money I can. You know, I want to do new countertops in my house and buy a boat. Perfect. The down payment assistance loan is great for you because it's going to cover a majority, if not all, of your down payment and your closing costs.
Yeah, I mean, I've seen people that have actually used their money and the down, and I've seen it happen twice. And let me tell you, right before closing, one of the guys got very sideways over his rate. And the thing about that down payment assistant, it's not like you gouge people in the rate. It's the same rate everywhere, correct?
Correct, yes. One lender to the other has the exact same rate. So it's like I said, it's funded by the state. The mortgage company that buys these loans is called U.S. Bank. So these rates are set by them in the state. We have absolutely no control over it. I mean, we make the same amount of money regardless. There's no, we're giving you a higher rate to make more money. That does not exist in lending anymore.
Well, and then I saw for another person who did it, it actually, by getting that $15,000, it allowed them to be able to not have any PMI. They had no mortgage insurance because they had enough to then have 20%. So for them, they were going to risk refinancing in 5 years for a better rate, keeping it, doing it. For them, that made sense. So it just depends. I mean, that person probably likes to bet on the races and bet on every football game too. You know, it just depends on your personality, I think, if people like to take risks or they don't. But at least now I understand it, because I know I bother you all the time since you came out with your new program, and I appreciate you taking the time with our clients. Does anybody else have any other questions at all for Josh? And I appreciate you working this late, because I have a feeling it's for at least one of my clients. Somebody's got you out here working.
Yeah.
I also want to say Josh is one of our biggest, I think most of you know, Heroes Housing Realty was based off of our nonprofit program. We are the Excel Realty Group. We do not only cater to Heroes, but a lot of our clients are teachers, firefighters, police, or military. And Josh, we just did a happy hour that he paid $2,500 in free drinks, and that was a lot of fun, from what I remember at least.
Free drinks are always fun.
Exactly. I think we're getting ready to do another one, in September maybe, like right before school starts. And then, yeah, you like that, Trey?
Get everyone ready for back to school and the stress of that.
Exactly. But the big deal is the cruise that's coming up in May. So we're going to be sending out information on that as well. Oh, we have another question. We've received, okay. They submitted an application and documents for a prequal. How do we know which program will be best for us? This is the deal.
Say that one more time.
They've submitted the application documents for prequal. How do we know which program will be best for us? There's two things I would suggest. I don't like to get involved when it comes to money or rate, like what your income is, how much you have in the bank, or what your rate is. I guess I was trained to ask how much people have in the bank when we go to start talking to them. I trust Josh completely if he says something's going to work or not work. If you'd like, what I can do is sit down and compare the programs with you, because with my background, I can pretty much tell you how much things are going to cost. But again, I think Josh is going to be able to show you both ways, or actually I guess all three, right, Josh? It would be the regular conventional, the bond, or his. And
yeah, we can go over everything. I mean, to answer that question, to know what is best for you, whoever you submitted that application to, it's got to go by them. I mean, you can read as much as you want on any loan when it comes to the expertise and the experience of the loan officer, because I can take a look at a file and say, okay, based on this and this, you make this much money, your debt is this much, this program is best and this is why. I mean, it's, when you go to a car dealership and the guy explains all the options in every single car based on what you want. It's the same thing to dumb it down, if you may.
I mean, and to be honest, before we had this conversation today, I had another client that Josh had been working with, and shockingly, Josh said, no, but such and such may do that. I wouldn't really recommend it, but here's a lender that does it. And just so you know, Josh, they went and talked to them and decided that you were probably the best option. But I appreciated your honesty, and I know, in your honesty and being able to at least say, hey, I can't do that, but I know this company does do that. So
yeah, I mean, and we're not greedy by any means. So if there's something that's better for your interests somewhere else, I'm absolutely going to refer you out there. Yeah. I promise you, we can cater to all needs.
Absolutely. So, but as far, and one thing I will say, because I've seen people do this to him, and I try not to and won't, because I used to be in his shoes, is he, when I think, would you rather someone get an idea of what to do and make a decision on the program. What I don't like seeing is when we're getting ready to make an offer on a house, and Josh is really great about not just doing a boilerplate pre-qual. He does a pre-qual and figures out the payment to the house you're about to make an offer. So we got to have a little bit of patience, and sometimes I don't, when we're getting ready to make an offer for him to be able to write the pre-qual and tell us what the payment is. That's not the time each and every house to have him show you for each and every house. I think maybe on the first one an example and then make a decision. But once we get closer and getting ready to make an offer, he will, because every house is specific, correct, Josh? The taxes are specific, the HOA is specific. So you may think, okay, I'm approved at 220, but then once we get the taxes and the HOA, you know what? If that's the subdivision you want to live in, you're only going to be able to buy 195, right?
Yeah, I mean, it's all about doing the due diligence up front. Because that's the thing you don't want is, I mean, like Scarlett said, yeah, if you're looking at 20 properties, that can get a little tedious. If you get an idea of what you're looking at and you find some properties that you guys really want, my team and I mean, just to sum up my team, so it's myself, my assistant Debbie, and James, and our processor Catherine, we're here for you guys. So once you start narrowing down that search and you start finding those properties, we will gladly crunch those numbers for you to give you an idea. I mean, and when you start looking at 20 homes, I mean, Scarlett, I'm sure you can agree to this. I've seen clients that see too many homes, and they end up not buying because they don't know what they want.
Yeah.
I mean, Scarlett's really good at narrowing down based on what your criteria is. I mean, what would you say? The average amount of homes you show a client, maybe 6 at most, before they make up their mind?
Oh, really? Okay. Well, when I started, I think, like, remember Jerome? He saw 40 houses. Oh, dear Lord. And it took him forever because he was in overload. Now, you know, yeah, I would think that it would, in a perfect world, it'd be 6. But there are some people, like even Celia on our board, she saw 28 houses. I would never go look at more than 6 houses a day. Some people are really, 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 really specific. I'm at the point now that was 2 years ago. Now, yes, you're right. I would say 6 to 8 houses because I like to get an idea of what everybody likes, and then when I research it and go back, and then by the time we go, we're at 6 to 8 houses. But when I started, it was 40, 28 per client, and those were the ones that took longer. They do love their homes, but yeah, we figured out that process. I would never, ever, 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 ever send Josh a list of every house that we're going to look at. What we do is we get you send me, you do your hearts and your light bulbs. I start looking and being able to see, my husband's watching sports and Landon's watching Choo Choo Train, and I'm sitting on the computer. And I'm looking at the houses and the ones that they love, and I start getting an idea for what they like. Once we go out the first time, at the end, you tell me what your top 2 are. I will then do what he was talking about, a CMA, and then we will go to Josh and say, what is the payment going to be? What we don't do is, before we go look, try and get a price. I've seen people, my daughter was a lender, I was a lender. I have seen people ask that of me when I was one, and I would not take advantage of my lender. That's a lot. So what we do is we find out he tells us on the front end what we can afford. We're in a range, and then when we go to the back end and get ready to make an offer, then we can figure out if that's going to work or not. And he's never been wrong yet. I've never had him tell me something was going to go through, and it's not yet. So that's pretty huge. But
well, I appreciate that. I mean, and that goes to show, guys, there's a lot of misconceptions. I mean, and this is just a sidebar. A lot of people think that us as mortgage guys, and realtors especially, sit up with their feet up You see a couple of homes, they write an offer. I mean, but there's a lot that goes into it. Like Scarlett said when she first started, clients are seeing 20, 30 homes, and, it's sensory overload. But when you have an experienced agent like Scarlett who knows and can pick up on your cues and your body language and your reactions to things and what you really want and know the market truly, that's when you don't lose offers. I mean, and coupled with a loan commitment that we're able to give you, that's when you don't lose a home. So there's a huge misconception about what it is we all do. But it truly is a business. And Scarlett's one of the best when it comes to that finding homes. So anytime you guys have questions, numbers, and like she said, a lot of people do tend to take advantage, but at the same time, this is your first home, and it is one of the biggest investments you're going to make in your entire life. So I know Scarlett's there for you. My team and I are here for you guys every step of the way. So anytime you have questions, there's days where, we're busier than others. I would say don't text me, call me. We get about 100 text messages a day, and sometimes I won't see them. But it's a great team, and it's a great time to purchase. It's an awesome market out there.
Yes, don't text Josh, call him. He's the oldest, youngest man I've ever met in my life. Because I'm like, quit calling me, text me. I don't want to answer the phone. I talk all day long. But it's all good. It's all good. Okay, guys, thank you so much. We've wasted enough of your time. It's 9 o'clock at night. Please, by all means, call Josh with any questions and send me a text. Y'all just don't want to hear Bibbly in the background if I happen to be at home. So thank you so much for your time. We're going to send you out, some more information on this. And Josh, I really appreciate your time, and we will talk to you later. Thank you, everybody.
Yes, thank you so much, everyone.